Andreessen Horowitz is the largest venture firm in the world by assets and barely a venture firm at all in the old sense. Founded in 2000 deals and a wealth management arm that manages its network's money. Where our previous issues firm answered venture's structural problem by making the fold permanent, A16Z answered it by making its wrapper limitless. This issue leads us to how the platform is built, why becoming a regulated advisor was the move that unlocked it, and what the model buys and costs. Founded in 2009 by Mark Andreessen and Ben Horowitz with a $300 million first fund and modeled under Hollywood talent agency CAA, A16Z is now the largest venture firm by assets, roughly $46 billion of committed capital in mid-2025, lifted by a record $15 billion raise in January of 2026, one of the largest in the industry's history. It runs a family of funds by sector and stage, growth, apps, infrastructure, American dynamism, bio and health, games, and a $7.6 billion crypto franchise, alongside its Perennial wealth management arm across more than 1,000 portfolio companies. Hello everyone, welcome back to our channel and welcome back to the template series. This series sits within our fundamentals to the noise series, and in this particular series, we examine how the world's most consequential pools of capital are actually built. Each issue takes a single institution. It might be a conglomerate, a sovereign wealth fund, a family holding company, or a venture firm, and reads its portfolio from inside, what it owns, how the pieces fit together, and the one principle of construction that makes the whole thing work. The aim out here is not to track performance or to chase tips, but to understand the architecture, why a firm concentrates or diversifies, how it engineers permanence, and where its structure gives it an edge, and when the same structure sets a hard limit. Taken together, all the issues map a spectrum from the maximal conviction of 5-name book to the maximal breadth of owning almost every listed company on earth, with most of the real portfolios sitting somewhere in between. So essentially what we are doing through the template series is helping you understand the fundamentals to the noise, the durable logic beneath famous names, drawn out one template at a time. In today's edition of the template series, we'll focus on Andreessen Horowitz, the platform that can hold anything. If the previous issues firm made its core permanent, A16Z made its wrapper limitless, a regulated advisor that can own any asset wrapped in a platform that sources deals, and a wealth firm that compounds relationships. Andreessen Horowitz is the largest venture firm in the world by assets and barely a venture firm at all in the old sense. Founded in 2009, it's a registered investment advisor that can hold any asset, private, public, or digital, wrapped in a media and policy platform that sources deals, and a wealth management arm that manages its network's money. Where our previous issues firm answered venture's structural problem by making the fold permanent, A16Z answered it by making its wrapper limitless. This issue leads us to how the platform is built, why becoming a regulated advisor was the move that unlocked it, and what the model buys and costs. Let's start with the portfolio. A16Z is less a fund than a federation of funds, state agnostic, sector specialized, and deliberately sprawling across asset classes that traditional venture firm cannot touch. Founded in 2009 by Mark Andreessen and Ben Horowitz with a $300 million first fund and modeled under Hollywood talent agency CAA, A16Z is now the largest venture firm by assets, roughly $46 billion of committed capital in mid-2025, lifted by a record $15 billion raise in January of 2026, one of the largest in the industry's history. It runs a family of funds by sector and stage, growth, apps, infrastructure, American dynamism, bio and health, games, and a $7.6 billion crypto franchise, alongside its Perennial wealth management arm across more than 1,000 portfolio companies. The founders frame the current priority plainly, winning the key architectures of the future, artificial intelligence, and crypto. When we talk about the most recent raise, that is the January 2026 raise, $15 billion, in terms of strategy, we see it has been allocated into growth, apps, infrastructure, American dynamism, biohealth, and other venture strategies. And as you can see on your screens, in terms of focus, for the growth, it is late stage and pre-IPO. For apps, it is application layer software. For infrastructure, it is AI and core infrastructure. For American dynamism, it is defense and national interest. For bio and health, it is life sciences. And as you can see for other venture strategies, it is across the sectors. And you can also see the amounts that have been allocated in terms of capital to each of these strategies and focus areas. Next, let's talk about the construction logic. The move that unlocked everything was regulatory. In 2019, A16Z gave up the venture exemption and became a registered investment advisor. An ordinary venture fund operates under an exemption that caps how much it can hold outside private startup equity, limiting its exposure to public stock, tokens, debt, secondaries, and buyouts. And therefore, in 2019, A16Z surrendered that exemption and registered fully with the regulators as an investment advisor, accepting heavier oversight and disclosure in exchange for freedom to hold anything. That single choice is what made the crypto funds, the public market strategies, and the push into private equity possible. It is why the firm can be described as barely a venture firm at all, a multi-asset investment platform that happened to grow out of venture. Around that advisor sits the platform, and the platform is a real differentiator out here. From the beginning, the firm was built like a talent agency, a large operating layer of marketing, recruiting, policy, and media that serves the founders, and in doing so functions as deal sourcing and capital raising engine. Set up in 2022, A16 Perennial manages the personal wealth, estate planning, and philanthropy of the firm's partners and portfolio company executives, converting existing relationships into managed capital, some of which flows back into the fund's deals. So essentially, you can see the circle being completed. The platform sources the companies, the funds back them, and the wealth arm manages the fortunes that those companies create. However, there is one structural question that the firm has still not answered. It remains led by its two founders, a source of coherence today and an open governance question for the day that they step back. And this brings us to the most important section of the video in every template series. What does the structure teach? Where the previous issue's firm made its core permanent, A16Z made its wrapper limitless, two opposite answers to the same venture problem, and a study in what a platform buys and what it costs. In the last issue, we talked to you about Sequoia, and today we are talking to you about Andreessen Horowitz. Both are elite venture firms, and their structural bets are mirror images. One narrowed onto a single evergreen vehicle built to hold a few winners indefinitely, and A16Z widened into a regulated platform built to hold anything and to do everything. One optimized the core and the other optimized the wrapper. And within its own industry, A16Z plays the role of a diversified reserve fund played in public markets that we discussed earlier. Here we are talking about the issue 2, and that is a Norway pension fund, wherein it selected breadth over selection, competing on scale, brand, and platform rather than on picking alone. The transferable lesson is about the wrappers. The legal structure an investor chooses quietly determines what they are allowed to own, and sometimes the highest leverage decision is not in which asset to buy, but in which vehicle to hold it in. In A16Z's case, the defining move was to change the wrapper, not the strategy. The platform carries the second lesson. At scale, sourcing and distribution, brand, audience relationships can matter as much as selection. For an ordinary investor, the point is modest but real. The account, fund structure, or entity that you use sets the boundaries of your opportunity set and is worth choosing deliberately. The honest limits are real. Venture returns follow a power law, and deploying tens of billions at venture-grade returns is genuinely hard. The larger the platform, the greater the risk that gathering asset crowds out the selectivity that produced the returns in the first place. A firm that can hold everything must still prove that it can choose well. And a different concentration creeps in. The model leans heavily on its two founders and on a brand that is now also political and media active, tying investment outcomes to reputational and regulatory risks that a quieter firm avoids. As with every portfolio in the series that we have covered, the platform is also a deliberate design, buying reach and optionality at the cost of focus. In conclusion, we can say that the wrapper can be a strategy. A16Z's defining move was regulatory, not investor-led. Becoming an advisor that can hold anything wrapped in a platform that sources and a wealth arm that compounds relationships. At buyer's reach, the open question is whether reach and returns hold together at scale. That's all that we have for you in this episode of the Template series. Stay tuned in for the next one.